Welcome, guests, to the Work It webinar series. You're joined by your host, Lisa Martens, and I am ably joined by the producer, Sonia, and our guest speakers today are Stephen and Mike, who you'll meet shortly. So as you get settled in, I'm going to remind you why we're all here. Today, we're going to get into the detail of revenue-based financing and show how you can help grow even faster using this method. It's non-traditional finance. And so we're introducing you to something really interesting today with some case study details as well as some real insights from a finance expert. For those of you who are part of the Work It family, thanks very much for joining us. And for those who are new to Work It, I just want to give you a quick intro about us. This webinar is being recorded and we will send you an email link to the recording tomorrow. So on to about Work It Spaces and who's hosting you today. So our mission is to help sustainable businesses to thrive, and we do that by creating really innovative ecosystems. We're joined today by our guest speaker, Stephen Duke, who is the country manager of Wayflyer. His business is actually part of our space, and that's why we're able to bring you such amazing insights and real practical advice today. And the reason that we were launched 3 years ago is that we know it's quite easy and quick to launch and connect an online store and begin selling, but it's still quite difficult to scale your physical operations. So e-commerce businesses, as you grow, you require different levels of office space or showrooms and storage, and logistics can become really quite complicated. As we know, some of the other things that are hidden, which are around that marketing and as well as the financing operations, it's quite tricky to make that work. So our e-commerce hubs were purpose-built to provide that flexibility around space. From dedicated desk showrooms and storage spaces, we have integrated logistics, but also those value adds like the photography studios, which members can use to help with marketing, as well as access to a digital agency. We're really excited that you're able to join us here today. And if you've got any questions about Work It Spaces, feel free to ping us on the chat or follow up with an email. But without further ado, let's get into the detail that we're here for today. So Stephen Duke, thank you very much and welcome back as our guest speaker on revenue-based finance. Stephen Duke, he is the country manager from Wayflyer for Australia and New Zealand. And they help e-commerce businesses to really grow by providing them with funding and insights. So thanks very much, Stephen.
No worries. Yeah, great to be here. Great to be back. Thanks, Lisa.
Cheers. We'll get into a little bit of detail around Wayflyer today. We really wanted to show you what they do. They're a member within our Work It space, and if you're keen to get in contact with them, let us know and we can make that connection for you. And we've also joined today by Mike Dovey. Mike is the founder of Heat Healer, and he's got a really interesting business model. They created from the ground up the infrared sauna blanket, which is really innovative. It's great heat therapy. I've been reading all your reviews, Mike. You've been doing really well. Thanks for joining us today.
Thanks for having me.
So today, Mike will be able to tell us how they used revenue-based financing to grow their business. You'll see later on the results that he got. I think it was 2x growth above what they were used to by using this kind of finance model. So really excited, Mike, that you'll be able to show some of that detail around what worked, how you found it, and what made it a real success for you and your team.
Okay.
We're going to kick off with some questions to our audience. We want to know, do you currently use a traditional financial model? Have you gone out for maybe a bank loan, credit card? What's that traditional finance that you're looking at? Are you using one right now? Yes or no? Let us know. Let us know if you're not sure. Nice.
Yeah,
We can see that.
I'm really interested to see what people see here, and like, we're going to use a few polls throughout it as well to try and get input from you guys. So,
Yeah, nice. And majority are saying no, no traditional finance. So if the world of finance is new to you, you're landed in the right space. We'll be covering a quite new model, particularly suited for e-commerce businesses. And if you're not sure what traditional finance you're using, because it's not your remit at work, you'll definitely learn today what you can pass on to the boss or the decision maker and say, look, this is something that we could be considering, and you'll see when it becomes a good fit for your business. It might not be now, it might be something for the future. So thanks very much for participating in that first poll. All right, let's kick off. So, Stephen, you're going to take us through today what e-commerce businesses will learn about cash flow, revenue-based financing, how to use that to grow, and then, of course, deep diving into what Heat Hiller's experience has been. Tell us a little bit more about what you want to cover today.
Yeah, so I mean, I think it's exactly these four things, right? And I think anytime that you look at a new product or a new service, you got to kind of start with, well, what's the problem that this is actually solving, right? And so that's where I want to kind of start the conversation. So I'll show you guys. Actually, this is what the problem e-commerce companies have, and we'll talk a bit about that. If you're completely new to revenue-based financing and you don't know what it is, I'll tell you exactly what it is. I've been working in it for years now, so I know kind of all the ins and outs and can kind of give you the inside baseball of how it works. And then probably the most interesting thing would be about how to actually use it, right? So everybody here is probably running a business and wants to grow the business. And so we'll say, well, okay, if you want to grow, this is how you can use revenue-based financing and to achieve some of the results that our customers have seen and the likes of Mike have seen as well. And yeah, obviously, it's always great to hear from actual companies and hear exactly what they've done, how they've used different tactics to grow their company. And that's why I think we're excited to have Mike here as well, to be able to share his perspective.
So just a quick poll, it'll really help us to see where the audience is sat in terms of this topic. Some people have heard about revenue-based financing and they've already submitted some questions, so thanks very much. But let us know, have you heard about revenue-based financing before? Yes or no? Oh, I love seeing the changes coming up. So it's about a 2/3 no and 1/3 yes. That's a great mix. It's great to see that term is getting out there. And if you've not heard of this before, then perfect. Let's dive right in.
Yeah, awesome. So yeah, look, for those of you who kind of haven't heard about it before, right, obviously you're in the right place because that's exactly what we're going to talk about it. And hopefully, even if you have heard about it, you're going to learn a lot as well about how to actually use it to grow your business. But yeah, I think the first thing is to talk about the problem that revenue-based financing solves, right? And so really what we found that we've worked with, there's thousands of e-commerce companies all around the world, and when we see they have really great businesses from lots of perspectives in terms of like really high gross margins, usually pretty good growth rates, and Mike can probably testify to all of this. But the one problem that we consistently see with e-commerce businesses is that they have a cash flow problem. And so on the next slide, I'll show you exactly why. So, well, actually, first, I'd like to ask you guys if you know why. So, yeah, there's a little question here. So, what causes the cash flow problem of e-commerce businesses? And don't worry, I'll go into more detail in a second, but keen to see what you guys think. Is it supplier terms? Is it investing in research and development? Is it slow paying customers, or actually you're just not sure and you want me to tell you the answer? So supplier, okay, fantastic. Well, for those of you who did answer supplier terms, like you're dead right. And so if you flip through to the next slide, I'll show you what we actually mean here, right? So if you're an e-commerce business, you have to order your stock before you can sell it, right? The vast majority of the times. And usually you're ordering it from, or quite often from overseas. And what the suppliers will do is like demand pretty bad payment terms. So you'll have to pay them 30% when you order it, and usually about 70% on shipment date. And then you probably have to spend a bit more on marketing before you ever even get $1 from selling any of the goods. And so what that means is there's always a huge demand on your cash flow, right? You need more cash than you ever have on hand, especially if you're growing, right? And so that creates a real problem for e-commerce businesses, because you're probably sitting there going, I know I want to invest in marketing or stock or new products, whatever else, but all of your money is just getting eaten up by having to just buy the next shipment of goods so that you'll be able to sell it. And so that's the challenge of e-commerce companies, right? They're great companies, really high potential, really strong growth, and usually great gross margins. but you're always limited by the cash that you have available, and that becomes a real challenge. Like, interested to get your view on this, Mike. Like, was this a problem that you guys saw in Heat Healer in terms of like having bad supplier terms that were kind of putting pressure on your cash?
Yeah, so for us, it is a consequence of our growth. So we have a product that fortunately would sell out pretty quickly, and every time we'd reorder new inventory, and the product's manufactured overseas, and we predominantly sell into the United States. So we'd have to move the product. Obviously, we have to put in the order with the manufacturer. That would take about 4 weeks for the manufacturing process, and then it would take another, maybe 6 weeks or 4 weeks on the boat as well. And then there's transit time from the boat into the warehouse, and then processing time. So all up, it's about an 80-day cycle from when we actually place the order and pay that initial deposit, where for us it would be anywhere from 30 to 50% of the total order price. And then the view was well, all that time whilst the inventory is being manufactured or in transit, it's effectively dead money. So for us, we're trying to figure out, well, how do we, how can we get better utilization of our money and effectively put that money to work whilst we're waiting this 80 days for the inventory to basically arrive, and when we can actually start selling it and collecting cash flow back the other way. So for us, every time we'd sell out, we'd have to go through this same process again, the same 80-day, waiting period. And I guess the traditional way of doing, if you're doing it on your own cash flows, is you'd get all the product, you'd sell out, then you'd order again, and then you hopefully order more, but then you sell out again, so then you need to order more without some kind of cash flow financing option in there. If you continue to grow, and that's what every business wants, you want to keep selling out as quickly as you can. But as you keep ordering more stock, unless you have some kind of cash flow financing option, you're never going to catch up enough in order to reduce that cycle down to what you really want, which is to have consistent inventory where you're not selling out, you just have it constantly being replenished on time as you need it. So that's the experience we had. It was supply chain issues as a consequence of growth.
Yeah, that's really interesting. I think it's, as you said, obviously, if you've got 80 to 90 days, of dead money, or and then that's just because the nature of how long it takes for you to get your product and when your suppliers need payment. But then, as you said, if you're growing, that problem only gets accentuated because you're selling it quicker, right? And so it's kind of it's definitely one of the downsides of fast growth that you guys have seen. But I think, like, hopefully, like, that problem is pretty clear to people now, right? Like, so you're kind of constrained on the cash side, and as Mike said, you've got, like, if you're ordering from overseas, that money is dead until you actually get the product and you're able to sell it, right? And so, the kind of natural next question is, well, like, what are the solutions out there, right? And so on the next slide, we'll see some of the kind of traditional options that are out there. So, if you've got kind of a cash shortage, obviously, if you look to bring cash in from outside the business, bring funding in from outside the business, and that can solve that. And so there's, like, a few different sources that traditionally, businesses would have used. So the first is equity investment. So you can go out and you can, raise money and sell a part of your business. You can go out and get traditional debt, like from a bank, if you're able to. And then, of course, you can kind of use your own funds, right, and put your own funds into the business. And, each of these can work, and, like, they do have their uses within a business at different times, but it doesn't really solve that cash problem, really, right? Like, the problem that is here is like a short-term cash shortage, where you just need to have the cash available to be able to buy the inventory, spend it on the marketing, and drive the growth. And there's downsides of these three sources, right? So if you're selling equity in your business, you're giving up control, and you're also giving up a stake in your business, and you don't get that stake back. So it can turn out pretty expensive in the long run. With traditional debt, oftentimes this just isn't available to a young e-commerce company, and you guys might have seen that. But usually banks require collateral or personal guarantees, which a lot of people don't want to give up, and oftentimes they just don't even have it. And finally, of course, you could put in your personal funds, but that runs out pretty quickly unless you're very well off. And so, you know, what people found is you've got this problem, there's kind of traditional sources out there, but none of them actually really solve it. And that's kind of where revenue-based financing comes in. So I'll tell you a bit more about this now. So if we flick onto the next slide, and we can go again, just onto the next one. So here's the same chart, right? So this is your cash flow. And what we saw in the last chart was that, you know, you had to spend out for inventory and marketing before you generated any revenue. But actually, with revenue-based financing, what happens is you get the funding up front. So you can see that big green bar on the very left of the page. What a revenue-based financing provider does is it gives you the cash up front, right? So you get that in your bank account, and you're able to then go out and spend it on all the inventory you need, or if you need to buy extra marketing, right? And so what it does is, rather than having, you know, to put up your own cash and having that sit as dead money for, you know, the 80 to 90 days, you can actually just use somebody else's. So the revenue-based financing provider gives you that cash, allows you to make those orders. Then what happens is, when you do make your sale, you pay back those funds as a percentage of your revenue each day. And so that's where you see on the right hand side of the page, you started to make your sales, and now you just start to pay back a little bit every single day. So I'll go into a bit more of the details about like how revenue-based financing works and, you know, the specifics of it, because I'm sure everybody's interested. But in theory, like, this is how it solves the problem. Cash up front, use somebody else's cash to make those orders, and then you can pay it back in the future when you've already generated the sales of it. So on the next page, I'll be able to show you kind of some of the companies that are using this, right? So obviously, you know, Mike from Heat Healer is using it, but we've got like thousands of companies all around the world, right? They started off kind of in North America, especially in the US. Some of the fastest growing companies are using this. Here in Australia, we've got companies like Heat Healer, obviously, but Soda Shades, Boomy, Mr. Poolman, who we had on the webinar last week, Tommy Skin, some really, really fast growing companies are using revenue-based financing to fund their growth. And so it's really kind of taken off as this big category, as a way for people to get the money to grow their business without kind of any of the downsides associated with the traditional sources. So on the next page, this is exactly what it is, right? So as you said before, you get the funds up front from a revenue-based financing company, right? Somebody like Wayflyer. Then you repay them as a percentage of your sales. And we'll go through a specific example later on in the webinar to show you how that works. There's no warrants and there's no equity. So you don't have to give up any ownership in your business. There's no collateral or guarantees. So you don't have to, you know, risk putting up your house against the funds. So you can sleep a bit easier. It's super fast. So banks are usually can be quite slow, right? So we're talking weeks, if not months, to be able to get money off them, whereas a revenue-based financer is able to turn it around in less than 24 hours. And it's not interest-based, so it's just one simple fee. It's a percentage fee on any funds that you provide. So the whole thing is, it's just simplified the whole financing process down and taken out a lot of the negatives that would have been associated with traditional sources of funding for e-commerce companies.
And Stephen, like you were saying, there are thousands of businesses around the world using this model. We say it's non-traditional because it's not something that's you know, been around for that long, but this is a fully accredited model, isn't it?
Yeah, exactly. So like, I mean, you can't provide funds to somebody unless you are, right? So it's not traditional, but it's completely trusted and, you know, compliant with all the regulations in all the different countries. So it's kind of that nice mix now, right, where it's like a really good offering, but it's not risky or anything like that. It's fully accredited.
And so it's just really about finding if it's the right fit for you.
Yep, exactly. And there's a few things that, like, few boxes that you need to tick, right? Because this isn't for everybody. And so what makes it the right fit for you is, first of all, if you've got good gross margins, typically we like to see over, you know, probably 30 or 40% above that. The reason being is because if you're going to repay it using a percentage of your sales, you want to make sure that you have enough gross margin that you're able to do so without putting pressure on yourself. You probably want to have at minimum 10K in revenue every month. Sell physical goods, right? So like some sort of product, like Heat Healer's product where you actually deliver it. It's not really for software companies. You have to have the potential to scale, right? So it's really for companies who are interested in and capable of growing. And so that means that your suppliers, you're able to ramp up your orders from your suppliers, you're able to ramp up your marketing. You want to be making most of your sales online and direct to consumers as well. So oftentimes we will work with people who have a retail presence or who are essentially doing some of their sales through wholesale. And if it's part of their business, that's usually fine. But there's always an element or a very strong element that is actually online and direct to the consumer. And so if you tick these boxes, it's usually like then it's a really good fit for your business.
Yeah, it's great to have a clear profile. I think if people looking, considering this model for their business and looking to grow, I think you're covering it next. And Tam, you're really looking for not just if it's a great profile, but how to make it a success once you've adapted that model.
Yeah, exactly. And very keen to get Mike's thoughts on these as well. But like what we see, like where this really works is, again, you want to scale, right? If you're just kind of happy with the current level of sales that you have, you tend not to get as much impact from revenue-based financing. It's really for companies who want to grow and also have the capability to grow, specifically with your suppliers. It's no use getting more money if you can't order more stuff, right? Or if your suppliers aren't able to ramp up their production for you. You want to be confident in your marketing. You want to know that actually you're able to go out if you put more money into your marketing, that you have a strong ROAS. So, typically on Facebook, we like to see at least kind of 3 to 4x like return on ad spend to be really confident that you're going to get a good return on it. And then finally, that your team is set up, right? If you're going to be ramping up your orders and you're going to be getting more sales, more customers coming through, you need to make sure that you have the back end and the operations to be able to scale this. But Mike, I'd be really interested to hear your perspective as well. Like, if there's a company considering taking on revenues-based financing and they're trying to say, is it the right time for me? Is it not? Are there any other factors that you think are important for them to be successful?
Yeah, I'd agree. The general principle is you have to want growth. That's the purpose of why you would take on funding like this. So you have to have some kind of growth plan or growth ambition that you believe could be funded with money upfront, as opposed to needing to wait for your net profits to come through to be reinvested back into the business. I guess the simple question that we sort of asked ourselves in thinking about whether revenue-based financing is the right thing for us. And just to pick an even number, let's just say it's $100,000 that we were going for in financing. It's just ask yourself, well, what can you do with that $100,000 if you have it here today, as opposed to needing to wait 80 days to get it all back and have it reinvested. So for us, it's about the time value of money and thinking about what an extra $100,000 could do in terms of our growth if we had it here now today, and avoiding that waiting period. So I think if there's people watching this and they're planning out their growth targets over the next few months, and maybe whatever the right number is that you're thinking in terms of the financing that you need, the simple question you have to ask yourself is, well, what can I do with that to grow that today? And is that growth going to be more than the fee that I pay to Wayflyer? So there's a cost in taking on the funding, and I understand that fee, it might be different for different businesses. Work out what that is, and then say, well, if I had that $100,000 up front today, is it going to generate for me more net profit and be more valuable than the fee that I'm actually paying back to Wayflyer? And I'd imagine if you're any kind of growth business, the answer is probably going to be yes, because the fee from Wayflyer is not extravagant. So if you are a fast-paced growth business, then you'd probably come to that conclusion that having the additional capital up front and what you can do with that is going to be many multiples higher than the fee that you actually have to pay to Wayflyer to get that capital up front. So that's the consideration I'd be putting on it.
Yeah, definitely. And how did you do that? Was it just kind of a bit of like financial modeling, like looking at your growth model and seeing like different scenarios about if you inputted the cash now versus in a few months' time? Or like how did you actually kind of get to that point where you're like, yep, this makes sense?
Yeah. So like a bit of context on our business. So I started this with my wife. My wife is actually the driving force behind it, and I help out with the financing side of things. So actually, my background is in venture capital, funnily enough. So, and I have a finance background, and I actually still have that as my day job. So I'm a director of Heat Hill, and I help my wife with all the operations and the financing, and she runs all the. She came up with the idea, and she runs the the creative and the product design and everything else. So for me, there's a slide you had a few pages back where you showed the different options of how we can finance things. And like most businesses, you start with your own financing, you put some of your own money into it, and that can only take you so far if you really want to grow. So if you're just going to be constantly reinvesting your own net profit, that it would be steady growth, and it's achievable, but a lot of, I think, entrepreneurs, you don't just necessarily, you're not aiming for just slow and steady growth. You want something that's a bit more ambitious than that. You want to grow as fast as you can possibly grow. So then you start thinking about, well, what can I do to get that? And people might think, well, I might sell some equity, like you mentioned. For us, it was not a consideration, given my background in venture capital and understanding that, and also the nature of our business. And I think most e-commerce businesses in Australia, and probably most of the people watching this, you're probably not going to be suitable for venture capital, at least in the early stages. So then it takes you to debt or alternative financing options. And I think if you go down the debt path, you'll probably find that the banks won't approve you, and even the traditional lenders won't approve you. So then the non-traditional lenders, or the new ones, probably won't approve you. So then it leads to things like revenue-based financing, which is what you guys do, which is so specific to e-commerce. And that's how we came across you guys, and we did the financial modeling to basically say, okay, well, this is the fee that we're going to pay, but we know exactly if we can accelerate our purchase of inventory and we can get that into the markets we sell into faster, we know that our net profit coming out the other end is going to be worth X%, which was many multiples higher than the fee that we need to pay to Wayflyer. So yeah, the simple answer to the question was a bit of financial modeling. It wasn't actually that complicated. Just work out what the fee is and say, well, what's your net profit? And if you're several multiples higher than that, then it's an easy decision to make.
Yeah, that's great. I love that. I think it's really cool as well to hear about, obviously with your background in finance and venture capital, to be able to see the pros and cons of different options, as you said, right? And venture capital obviously, plays a really, really important role in the right business. But you said you said that it's not probably suited to most e-commerce businesses in Australia. Why is that?
Until you get to a certain scale. So, once you get to a certain scale, then anything is possible. But I think that, and even looking at some of the brands that were shown on the page before, and our business as well, I think for most founders that have a product idea and they're picking a niche that they want to go after, and they probably start the same way that my wife and I started, which is a couple or two friends or whatever, and you start a business together. In those early stages with e-commerce in Australia, there's not a huge amount of venture capital financing even available, to be honest with you. It traditionally likes SaaS-based businesses or deep tech-based businesses. So most e-commerce businesses in Australia are probably just not suitable for VC funding until they get to a certain point where they've really demonstrated scale and product market fit and everything else. But there's a huge gap there in the earlier stages where there's still financing needs and cash flow problems, where it's just a sector of the market that's not serviced at all by the banks or even some of the new lenders. So there's some new lenders emerging that say that they're more forward thinking and that they get under the covers of businesses more closely to understand the financing needs. In our experience, it's kind of not true at all. Like, we went to some of the the new lenders that sort of pitched that, but for them it still was very much a tick the box exercise where they just don't understand e-commerce, even to the point of they looked at us negatively in the fact that we sold out all the time, which is ironic. So they look at us and go, "Oh, you sold out all the time, so why are you not making sales when you sold out?" And we're like, "Well, so we don't have inventory. That's why we need to get the financing so we can shorten the inventory cycle." So anyway, you guys are filling a gap in the market, which you know, I think for us and for probably the people watching this, yeah, it's probably the financing option that makes the most sense, I think, for early stage young e-commerce businesses.
Yeah. Yep,
And certainly
definitely.
growth can be a tactic, not just an objective. So obviously businesses intend to grow and do well with their operations and their product, but it can also be a tactic. So you might need to grow very quickly to keep a competitor or a disruptor that's coming to the market trying to take that market share out. It also really helps you to, you know, cement your space as a market leader if you're providing a disruptive or a new and innovative product in the market. It's really important that you make that beachhead in market share very early, so it can help you to accelerate. So can we have a look then about, you know, you were saying, Mike, around what makes it a good fit for your exact business. Steve, could you take us then through, you know, an example of some of that detail?
Yeah, exactly. So this is like, right, like people are probably like, okay, cool, that this all sounds great in theory, but like, how does it actually work, right? So this is how it works. This is an example deal that will be given, and we've actually used the same $100,000, right, to make it easy, like Mike did. So really, what happens here is you'll go to a revenue-based financing provider and you'll ask them, hey, can I have some money? And you'll usually have an idea of how much you're looking for, right? They'll come back to you with an offer that will look something like this, right? So here's the $100,000. That's how much is going to get sent to your bank account, and you'll have in cash to spend as you want, right? The principal, if you will. The next part is the fee, and so this is based on a percentage. And so for the example here, we've used 6%. It can be much lower. It can be a little bit higher, and it's always tailored to the specific business. But just as an example here, it's 6% on $100,000, which means that's $6,000 fee, right? So that's the actual cost. When Mike was talking about, you know, you got to look at the cost, like the actual fee that you're going to pay. This is the bit that you pay, right? The $6,000, that's the actual cost of the finance. And so really what that means is then the total repayment is obviously the 100 plus the 6, so $106,000. And how you're going to repay that is by using a percentage of your daily sales. So it's kind of like a revenue share agreement. So you get the $100,000 in your account, the 6% fee is applied, and then for this example, it's 10% of your sales is going to be used to repay the funding. And so what happens is each day you'll see how much sales come in through your online store. If you use Shopify, WooCommerce, Magento, whatever it is, apply the 10% to that amount, and then that amount gets sent back to Wayflyer or the other whatever revenue-based financer you use until the total amount is repaid. And so the cool thing about that is it aligns with your sales and your cash flow, right? So if you have a good day of sales, that's great. You'll pay back a bit more. But we all know that, you know, businesses can be quite cyclical and seasonal. And so if you go through a patch where actually you're not doing that many sales, it's just a percentage, right? So it's still just 10%. So you're paying off a lot less every day as you go through those periods. So it's really just about kind of minimizing the risk and kind of aligning it with your cash flow. So this is an example deal. Typically, you know, repayments are somewhere between 3 and 5. It takes about 3 to 5 months to repay the total amount. So it's, you know, shorter term financing. But what we find is companies will often use revenue-based financing like multiple times per year, right? So they might align it with times of the year where they need to make big inventory purchases, right? So of course, one of the busiest times of the year is probably August, September, because people are placing their orders in those months to make sure that they have the stock arrived and ready to go as they come up to Black Friday, Cyber Monday, and the holiday period. And so it's shorter term finance, but it can be used multiple times. It's all about when you've got those spikes in your need for cash to make, especially to make inventory orders, you can use revenue-based financing to smooth all that out.
And so you're saying it's really about kind of being comfortable about when you take that up as well.
Yeah, exactly. So, you know, I think Mike earlier was talking about the different stages of the business, right? And like what's suited to different stages. And so when you got to think, right, like you've got everything from you've just started out, you might be doing this business as a side hustle, right? So you're just getting started. And you got to look then at what options are available to you to fund it, right? Outside of revenue-based financing. So you've got a few, you can bootstrap it, you can use your own money, friends, family, you know, you can start to put a bit on your credit card if you need to get by. Crowdfunding is a good option, especially if you've got a cool, innovative product that you're going to be able to create a cool crowdfunding campaign around it. But that's just to get off the ground. Once you hit kind of like a growth stage, you're already making some sales, as Mike said, like you found product market fit, like you clearly have customers who like your product, your marketing is working. Then venture capital can open up as an option for you, right? Again, of course, it depends on the type of business that you have, but that can become an option, especially if you have the potential to go into a really, really large company, like billion-dollar company. But obviously, once you've hit that $10,000 a month, revenue-based financing is open to you as well, right? Now you get bigger again. You're doing tens of millions, maybe $50+ million a year, $100 million a year. Then revenue-based financing is still an option, but you'll usually also get the option of having kind of traditional bank debt. So once you're doing a few hundred million a year, the banks start to like you again, and will usually approve you for some funding as well. So it's interesting to think about different stages. It's not one size fits all. As you go through, as you grow your company, different financing becomes available, and different and they're better suited to your needs at different stages of your kind of evolution.
Nice. Thanks, Stephen. I know that we're about to hit that next section, which is how to use revenue-based funding to grow. And I think, when you're hitting scale in your growth stage, some of those indicators that you're doing really well and then you've got extra capacity to fulfill can be pre-orders. If you're running a really long pre-order and you're growing your database that are consistently as you sell out, or you're hitting low stock very quickly. So if you're having that the days to sell continues to become shorter, and you're looking at revenue or pre-order campaigns that are doing really well, that can be also really good indicators to see if revenue-based finance might be a good spot for you.
Yeah, definitely.
Awesome. So if this sounds like that's something good for you, then obviously you're starting to think about, okay, how to make the most of it. And so Mike, you were saying like you had a plan, you'd visualized what it could mean for your business, and then you were really looking at those financial modeling to make it work. But then if you're getting into the how to use it to grow, what are some of the best ways to make that work?
Yeah. And I think it's helpful probably to give a quick understanding of the process, right? So because we've not really talked about that, and people, I want to be as tangible as possible for people in terms of so that they can go away, and if they're interested in it, they know what to do, right? So if you are interested in revenue-based financing and thinking about how to use it to help you grow, the process to actually get the money is pretty straightforward, right? So the first thing is you approach somebody like Wayflyer. You can actually just sign up directly on the website in about 3 minutes. And what you do is you connect in your e-commerce and your marketing platforms to Wayflyer. And what that does is that gives us an understanding of how well the business is performing. And it's what allows us to generate funding offers for you, right? So as Mike said, some of the, new lenders on the block might say, oh yeah, we get under the hood and we understand your business and we're able to make better decisions. But if we actually do, because we built like a whole product to do that, and so we see all the real data, and that's what we're making decisions on. We're not making decisions on business plans or kind of assumptions basically. So happens you connect up, we then will have a chat with you, talk through the funding offers, like the example that we saw. You kind of just complete a financial review, which is usually kind of a 30-minute call with one of our finance team, and then you get the funds sent direct to your bank account. And so really like the whole process honestly can be done in less than 24 hours. We've had people approach us and within 24 hours had $1 million in their bank account. So it's really, really quick, and it kind of kickstarts the growth process. If you're ready to go, you don't have to wait around. And so, on the next slide then, I can kind of show you a bit about like what we see across all the companies that we work with, like what's the actual best way to use it. And it's it's very similar to what Mike was saying earlier, but what we find is that there's two things that need to happen side by side, right? One is you need to have inventory. You need to buy the inventory. This other one is that you need to increase your marketing budget. And the two of them need to work side by side, right? Because if you have all the inventory, but you're not increasing your marketing budget, then you just got inventory sitting in your warehouse, which is useless. Vice versa, If you're just increasing your marketing budget, you're just going to sell out all your inventory straight away, and then you're going to be back on pre-orders. So we do see it's very important to be able to increase the two of them in lockstep, and that's how you really use the funds from revenue-based financing to drive the maximum amount of growth for your business. So, Mike, is this a model that you guys think about? Kind of bringing the two up in line? Have you ever kind of been too far one way or the other?
Yeah, correct. So we looked at it. So a few slides ago when you had that example in the payback period, and I think in the example it was 10%. So one way we were thinking about that was, so a few metrics that we understood. So the first was our return on ad spend. So we have about a 10x return on ad spend, and that's been pretty consistent even as we scale up. So you would think, we don't know where that starts to cap out. We'd think at some point, we spend so much money on marketing that return on ad spend should go down a little bit. There must be some kind of limit we can hit, but we haven't found that yet. So we stay at 10x return on ad spend. Then we think about, okay, our inventory purchase. We know as soon as we have the inventory, we sell it super fast. So I just matched up our cost of inventory as a proportion of our sales, which for us, our inventory costs about 35% of the end sale amount. So for me, I'm happy to, and I actually asked for this with you guys, which is to have a higher percentage as my payback, because for me it's as simple as I want to fund all my inventory with Wayflyer, because I know as soon as it's available to sell, the more I can pump into marketing and PR and all those other activities to ramp up the sales even more, I'm going to get a 10x return on my ad spend. So for me, it was free up as much cash as I can possibly free up by having Wayflyer fund all of my inventory, and then I'll take all of that cash that I get up front, or that surplus cash I now have, and put that on the other side in my marketing spend, and just try and sell even faster. And for me, it's all about just the velocity of money. So it's just trying to repeat that cycle as quickly as I can. I want to pay back the money to Wayflyer as fast as I can, and then as soon as I pay it back, I want to get even more. So I'll increase from 100,000 to 150 to 200. I want to keep repeating that cycle as fast as I can repeat it, until I find what sort of limit there is on my business being able to scale. But I feel like we're so far at the beginning of that, it's not really a concern I have.
Mike, did it feel like it was a step change for you? So you got, you experienced 2 times growth using this kind of finance model. Did it put pressure on your business that was unexpected, or did you feel like your planning, your supply chain was able to cope with that? Did it feel like a good ramp up?
It was. So one of the learnings we had, so there's obviously a logistics issue when you're scaling things up, and that's just a natural part of growth. There's you have more customers, and more customers have more questions, and there's more problems, and as well as we started going into other markets, so into the United Kingdom and coming to Australia as well. So there's just more going on. So you got to prepare yourself with that growth, and accept that as one of the realities of scaling up. But then the other sort of learning we had in it was, yes, it was good, and we sold out again super fast. So we did exactly what I just described, and we pumped a whole heap of money into marketing, and we sold out again really fast, which is good. But then we were on back order for a long time as well, whilst we were waiting for the inventory, which a whole heap of new inventory we just purchased using the funding from Wayflyer. But one learning we had was probably don't go on back order for too long as well, because that was a challenge for us. It's great to still have those sales coming through, but then there's customer issues when they're waiting for the product. So yeah, the financing we got, it did allow us to jump pretty quickly to grow our revenue by 2x, and I think we'll probably be able to keep multiplying that a few times over. But for the next sort of step change, I think that'll come, which might be in probably 2 to 3 months, I think. We'll probably be a little bit better prepared in terms of the logistics as well, with regards to how we manage communication to our customers and manage just the general issues with supply chain that come when you're scaling up quickly.
Yeah, it's a really good point. I mean, every e-commerce business is feeling it right now. In particular, 2020 had a real impact on supply chain and manufacturing. And so, if you don't have that good relationship where you can actually query and really put pressure on them to say like, yes, but is it really going to happen? It does mean that you carry that risk in terms of the customer relationship and brand experience.
Yeah, that's right.
Oh, nice. Um, what else did you think? Well, you know, it unlocked that opportunity for you, and you said you're willing to use revenue-based financing again. Did you feel like it made you more confident in your financial? You've got great financial literacy with your background and your experience, obviously, but did you feel like this is a model that can be part of my business all the time?
Yeah, we will keep it as part. So my philosophy on it is that until we get to the point where we get a very good deal from a bank that can offer us a huge sum of cash at an incredibly low interest rate, or if Wayflyer, gets to that point with us as well. But we'll keep repeating this cycle over and over again with our inventory, because it just makes sense to do so. We want the cash upfront, and we're more than happy to have all of our inventory funded via Wayflyer, and we'll just keep selling it. And our goal is to not sell out. We want to get to the point where we can operate in multiple geographies, which, predominantly we've been in the US, so we're probably going to go through the same experience now in the UK, that we've got inventory there, and we want to get into Canada and Australia and New Zealand. So, there's a lot of scale ahead of us. And I think until we have consistency of stock in every market we sell into, we'll keep funding it entirely through revenue-based financing. Because it's just as simple as, we look at the fee we pay and we say, yeah, but we know when inventory is there to sell, the profit we get back on every sale is just such a high multiple of what the fee is. It just makes perfect sense to do it. It doesn't make, if we want to grow that quickly, it just doesn't make sense to do it any other way.
Perfect little time to have a chat about, key takeaways about revenue-based financing. And then we can open up to some questions as well. We've got some questions coming through. And if you have any questions, feel free to use that chat session. Sonia and I will be able to see them and pass them across to our panelists as well. So, Stephen, I guess we know people considering revenue-based financing, what we've got to think about is understanding their options based on where they are in terms of their own stage of their business, making sure that they hit that checklist around, do I fit what a revenue-based finance model provider is looking for? And we can provide that not only in this webinar, but as a downloadable from tomorrow. And then also making sure that you're ready to scale and that you have the ability to back it up with supply chain, and also that your marketing's in really good, healthy shape. And then, Mike, what I'm hearing from you is that you're also making sure that you're confident that this is going to be good for your business, that it's the right solution for you at that time.
Yeah, I think, yeah, definitely. I think, sometimes the way I think about it, right, is like, if you've got the engine running, like you've got a product, you've got marketing, you've got the supply chain and the operations to support it, then revenue-based financing is the fuel, right? It's just putting fuel into the engine and allows you to really accelerate the speed you're going at. But if you haven't got the engine built, that's where you need to start, because it doesn't matter how much fuel you put into an engine that doesn't work, it's not going to go very fast, And so I think, like, yeah, hopefully, the takeaways, I think, from this should be, hopefully a little bit more of an understanding around the actual, like, challenges of an e-commerce company. So we said lots of great things about e-commerce, right? But one of the challenges is cash flow, and it's usually driven by your suppliers. And a bit more of an understanding about the different sources of funds that are out there, like when they're a good fit, when they're not, and why they don't really solve the cash flow problem for a growing e-commerce company. And then hopefully people understand a bit more about how revenue-based financing works, right? So cash up front, you pay it with a percentage of your sales, and it doesn't have any of the downsides of giving up equity or collateral guarantees or anything like that, And then obviously the last part, which Mike shed some really good light on, is, okay, well, if you do decide to go for it, how do you actually use it to grow your company? So using the inventory and marketing, scaling them up together, is really the best way to get the best bang for your revenue-based financing books. So I hope it was helpful for everybody, and that people learned something.
Yeah, we've got a question that has come through, and I think it's a really good one. What should I look for when choosing a revenue-based financing provider? So what makes a good provider?
I'll give this one to Mike. He's probably more unbiased than I am.
Mike,
So,
what was really helpful for your business?
so you guys were fast, which is great. Like the 24-hour, turnaround is not exaggerated. Like you guys, I think actually when I put in the initial request or contact, which was at night time, I think it was about 8 p.m. at night, and you guys responded at 9 p.m. at night. So you're right onto it. And then we had a quick phone call, and I'm pretty sure things were, at least indicatively approved in 24 hours. It might have been 48 hours or whatever it was, but it probably would have been me considering it. Like there was no, sales pressure or anything like that from you guys. But so I think that was helpful. If you're considering, if there's multiple revenue-based financing companies that you're considering, the responsiveness is obviously important, because ongoing as well with the relationship, and as you start to go through multiple cycles, that speed I think becomes even more important. So you're running a business and you have financing needs that might come up quickly, or you go, okay, actually we've got to secure this order like by the end of this week with our supplier, which means we need to go back to Wayflyer, and we talked about getting more financing, but now we need to lock it in and make sure the funds are in the account by Friday, for example. So that sort of speed and responsiveness is really important. The other thing, so there's a few advantages with Wayflyer as well, as I'm thinking through the question. So one being that the cash is deposited into your account for you then to pick how it's going to be spent on inventory or whatever else. There's not a complicated invoice financing component to it. So I know some of the other revenue-based financing companies, you have to submit an invoice. The invoice, so you have to submit an invoice from your supplier, whoever that might be. That invoice, that supplier has to be approved. Then once the supplier is approved, the invoice has to be approved. Then there's a transaction fee on the payment of the invoice and a currency conversion fee as well. So look out for hidden fees as well, because that, you gave an example of 6%, which Wayflyer has been 100% true to in terms of the fee we pay. We pay a set fee. We know exactly what it is up front, and there's no other hidden costs or charges. I do know with some other revenue-based financing companies, they might have a headline fee, but then it's like you submit your invoice from your supplier, which might be 100 grand. It's like, oh yeah, but there's a 2% invoice payment fee. And you go, okay. And then they go, oh yeah, but there's a 3% currency conversion fee because you have to pay it in US dollars to to Australian dollars or to the yuan or whatever. And you go, hang on, now it's up from 6% to 10%. What happened? That happened fast, and it took me an extra 5 days to get it all approved because I had to go through this process. So so look for transparency in the fees, that you're paying one simple fee and you understand what it is. Look for the speed of responsiveness and how quick you can get the money, and then look for the processes behind it as well. So the faster you can pay your suppliers and pay your marketing spend, the better you're going to be as well.
Yeah,
Yeah,
I think
got to work at the speed of e-commerce.
yeah, which is fast. But no, I think that's. I think the only thing I'd add from the customers, that I work with, that they say is about the flexibility to actually tailor an offer to their needs as well. So, like Mike said earlier, we probably had a few initial offers for him to look at, and he said, actually, can we bump up the percentage of sales that we're using to repay, right? So it's not like a cookie cutter approach. Like every offer is actually tailored to the company, and the company can say, actually, do you know what, can we go a little bit higher here, a little bit lower here? So it's all tailored to their exact needs, and every company is different, right? And so having the ability to get finance tailored to exactly what you want, and actually having a say in what the terms are, I think is really valuable to a lot of companies. But not everybody does that. Some people are just like, no, look, here's our basic terms. This is what it is. We don't care if you want more or less. Like that's kind of all we do.
Yeah, perfect. I've got, in our last 5 minutes that we've got, I think this question is a really interesting one. Can you use revenue-based financing for longer-term investments, like buying a new warehouse, new storage space?
I would say no. So yeah, so because the payback period is relatively short, usually between 3 and 6 months, you're going to have to have paid back all of the money before you even, usually before you even get that warehouse or whatever other long-term initiative you're getting in, right? So why it works for spending on inventory or spending on marketing is that you're going to get the income from that investment, before you have to finish repaying the funds. And so you're tying up the benefits of the funding within the same time schedule that you're going to have to repay it. So that's why it makes a lot of sense. Some of the other sources of funding will be probably better suited to more longer term initiatives, I would say.
Perfect. Well, if you have any further questions, feel free to email the panel. You've been talking with Stephen Duke and Mike Dovey. I really appreciate your time this afternoon. I feel like I've got lots of insights. I feel like I know a lot more about revenue-based financing, and we're in this space. So, Mike, I really appreciate the insights that you've been able to share with us around what it actually feels like for a business to take on the responsibility of finance. Finance can sound extremely exciting and unlock a lot of doors, but you can also, like you're taking on accountability for the business. And when you're ready for that responsibility, making sure that you're ready to scale, that you're ready to dial up your marketing, that you can see how your business will benefit from it is really important, because then you know that you're making good decisions. So I really appreciate, have you been able to share that experience with us?
Thanks, it's been good.
So that is the end of our webinar. We are recording this webinar, and we will send you a link. We have further resources if you're looking at e-commerce and supply chain finance. We've done additional webinars on accounting and finance. We've got some great webinars coming up. So I invite you to have a look and also vote. Use your voice to say what you want to help your business grow. We're very keen to make sure that we're answering your questions. So check out our blog, check out our events, and then send Sonia and I emails around what you're keen to see, what your business is really challenged by. And so we'll be sending you a recording, and at the end of this session, let us know if it was good, if it answered your questions, or if you have more through a 1-minute survey. It'll be nice and neat, and it helps us to make sure that we get the right guest speakers and fantastic subject matter experts and business owners. So thank you very much for joining us today. I've been Lisa. You've been here with Sonia on the production of the webinar, Stephen Duke from Wayflyer, and Mike Dovey. And thank you very much.
Thanks, everybody. See you.
Thanks. Bye.